Hey, Greg, if you're there, oh, he's gone.
Hey, bud, can you
There
hear
he
me?
is. I can hear you
Hang on, I
now.
gotta change my audio.
I can see a little color in your face.
Yeah, it's starting to fade already.
Cleveland will do that to you.
Yeah. It wasn't tan enough. I wish I was still down there. Come back to nothing here.
Come back to another snowstorm rolling through.
Yeah, it's crazy. We've kind of dodged the bullets with snowstorms this year, where we're literally just south. We've kind of, it's been mostly rain. We've had kind of a crap winter. Where very limited snow, a lot of rain, and I don't want rain. If it's gonna be wintertime, I want snow sports, all that stuff. Where
Yeah,
I don't want the rain. We've just got more rain than anything else.
yeah, same here. It seems, you know, I think Chicago is unique because we're right on the lake, and that when the winter storms come through, something about the lake pushes them south. If they
Yeah,
come from the west, when they come from the north, then that really kind of pounds us. But
yeah. Typically, we get a lot of lake effect, but this has just been. If you like skiing in winter, my wife is in love with winter, and it's just been a miserable winter. In that it's been mostly rain, very limited. I think we had a stretch of snow got early on, maybe for a week and a half, 2 weeks, a continuous snow on the ground, but that's it. I mean, it's, we've got flowers already
yeah, right.
popping here, where at this point, we're just setting up for, we're going to have a miserable spring, and then we'll just immediately jump into summer as our payback now.
Yeah, that's that. Yeah, that is the case. The mud season is going to last for spring officially lasts very short time, and then we just have that mud from
Yeah.
mid-April to June 1st.
And, like kind of with lumber, you've seen that now. Where Big Eastern Mill had a couple of shutdowns, and I think it has less to do with returns and more to do with inability to build out log decks in Quebec, where you typically should have the frozen tundra, and they just really haven't had a normalized winter here, where you have soft roads, the road bans in place way too early, where that ultimately will become an issue, I think, in Quebec. Especially potentially even in Ontario, and obviously just not now, but down the road it will be a bigger issue.
Indeed, indeed. Well,
Let me
let's get this
share a
thing kicked off
screen
here.
here. Let's see here. Where are we at? Here we go. Here's the screen. And then, yeah, it's good to be back. I think you were out a week. I was out a week. So thanks to Kip for filling in. And I think it's been a good 3 weeks now since we've both been on the call together here.
I know, I know.
Shameless plug to start with. Alex Mead and I are still hosting a StoneX Lumber Risk Management Academy. You can kind of see the details. It's in Nashville, the end of April. The slots are filling up. We're expecting a full house, somewhere around, I don't know, 25 to 35 people. And this is more of an intermediate. If I were going to equate this to, future 101, now this is probably futures from the 300 level and higher, where it's going to be much more kind of not at that ground level. It's going to be more of the intermediate to advanced level with options, technical analysis, more advanced basis type strategies. So if anybody's interested, there are the details. You can contact me, and we're more than happy to pass this along.
I can't recommend that enough as well. I mean, look, I've been doing this for 20 some years, and what I know is that everything, it's always evolving. The next greatest thing is coming down the pipe. There's so much money at stake here that people are always looking for an edge. And by all means, this type of education will give you an edge.
Yeah, absolutely. And, like the idea that you can learn everything, absolutely not. If I don't learn something new every day, then what's the point? And lumber is extremely one of those humbling markets where it has a tendency to teach when you least expect it. Like last Tuesday when we had the limit up move in May, there really wasn't a good reason, rationale behind it, but that's lumber. So if you have any questions, please contact me, contact Alex, contact Mike, and we can get more information.
Yes, please.
And away we go. I think the big thing that stands out to kind of start off, Mike, is that Fed Chair Jay Powell is speaking to Congress today and tomorrow. So Congress today, the Senate tomorrow. And shockingly, he basically has been said what the Fed's been saying for the last 2 months now, and somehow it was a surprise to the markets. Where the Dow right now is down just under 400 points, the Nasdaq's down 83, S&P's down right around 49 on its lows right now. So, when you look at kind of when I redid this after 2 or 3 weeks, equities are going nowhere fast. Crude oil has gotten a little bit of a push to the upside. The big thing that stands out is obviously rates trending in the wrong direction. And the byproduct of that is as rates go higher, that's a negative. That's definitely a headwind for housing and a headwind for lumber, where your 10-year note is back in that 4% area. And so when you kind of dig down, and the one thing I'll kind of, and kind of where I'm going with this is the Elliott Wave guys are trying to project some kind of a bottoming formation in equities, more based upon wave count, more technical in nature. The big issue I have with equities as a whole is you're buying something under the idea that there's appreciation, and that appreciation comes with risk. And when you look at what the Fed is doing with interest rates, and I'll come back to this dollar, I'll come back to this, but so again, Fed chair said interest rates are likely to be higher than previously anticipated. So we're going to be higher and stay there longer. And again, the Fed has said this all along, going back to the beginning of the year. The market is finally, I think, trying to come to grips with the idea that there isn't a pivot off of their policy anytime soon. And so, when you look at terminal Fed funds rate, you're probably talking a 75% chance. The next meeting is March 22nd. So the market is building in a 75% plus probability of a half a basis point increase. And now the market is even starting to build in for April, not only another quarter, but potentially another half. So rates are going higher, and the trickle down effect, and kind of where I'm going with this, you have 10-year notes back at just around the 4% threshold. They were above 4% late last week, even into yesterday. And so you're getting back up into those November levels. But and I'll come back to this one, but I added a 2-year treasury here. And so 2-year treasuries are just under 5%. And the headline today with 2-year treasuries, new highs, you're back to 2007 levels in 2-year treasuries. So this is legitimate. This is risk-free returns versus equities, where you finally have competition with equities. No longer, equities all along here have been the only game in town. Where are you going to put your money? Well, the answer is I highly encourage everybody. You can go to treasurydirect.gov and open up a treasury account. You can go buy treasury bonds. You can go buy T-bills directly from the U.S. government. This is risk-free. This is you have cash sitting there earning pretty much nothing with your bank. Maybe you have a credit union that's giving you a higher return on a CD. You can go buy 2-year, you can go buy 30-day, 60-day, 90-day treasuries, T-bills from the government and get legitimately a 2-year treasury is yielding 5%. So
Now
my
I
point
will.
with this is risk free. You're getting paid to sit in cash. You want to try to pick a bottom in equities, that's fine, but you can't say that there's not risk in doing that. At the very least, if you're an equity trader now trying to pick bottoms, trying to pick value in certain sectors, you better be getting a dividend that yields close to what treasuries are yielding right now, because you're getting paid risk free. You can make 5% on a 2-year treasury. You can make
Wow.
4.5%, 5% on a 30-day, 60-day, 90-day T-bill, 6-month T-bill, 6-month CD. You know, what time frame do you want? But if you have cash just sitting in the bank right now, it's inexcusable. Go get a return on that money. I mean, this
Yeah,
is free money right now.
cash is smoldering because of inflation. So this 5% you're getting, you're really not if you compare
Yeah,
it
yeah.
to the
But
inflation.
sitting in
But
cash, you're
sitting in
just,
cash, you're getting
yeah,
negative return.
yeah, and putting it in equities, assuming that equities have to appreciate. Not only do equities not have to give you a return on your investment, equities don't have to give you a return of your investment. So sitting in cash, no, you should be sitting in treasuries, depending on what part of the yield curve you want to be in. You want to be long term, intermediate, short term. You have all these options. At least, again, I'm going to go back and, rarely am I going to plug the government here, but go. This is, I don't get anything from this. Treasurydirect.gov. You can go buy whatever you want, but you should not be sitting in cash. Do something with your cash. At least get some kind of return on it. That's my second shameless plug, the last of my shameless plugs today.
So I'd like to point something out too. This is great analysis, and this is slightly myopic as an American or North American. We're looking at just US. But the reality is the Chinese government just came out and they basically said we're going to be okay with just 5% growth.
Yep.
And this is huge from a global perspective. They are so concerned about inflation that they are afraid to hit the gas pedal, which in the last, 10, 15, call it 20 years, they have had so much stimulus to get their economy to where it is, which obviously has worked. They're quite a powerhouse. But I was taken aback by that a little bit. They basically came out and said, we're
Yeah,
okay with it.
and I'll go back, Mike, to so we always talk about the U.S. dollar, and as the Chinese government came out and said their GDP growth is 5% thereabouts, that freaked the markets out that it wasn't higher. I think the expectations were 6.5 to 7% plus. So you had this flight to quality. You had this shift out of foreign currencies into the U.S. dollar, and so the net impact over the last 24 hours, really over the last call it 3 weeks, is you've had the U.S. dollar index go from that 101 area up to 105. Right now, the U.S. dollar is a 105.35. So you've had this flight to quality into the dollar. Again, a strengthening dollar is usually negative for commodities. It makes US dollar denominated commodities more expensive. A weakening dollar makes US commodities more attractive. So you can kind of see, and again, this is just literally the last 24 hours. And again, a lot of this is obviously with what Powell had to say, but again, S&P's on its new lows now, down 50. Dow's down about 450 now. Crude oil, dollars appreciated. Crude's down about 250. Gold's down about $30 today. Copper's down. Lumber's kind of in its own little world, but again, on a short-term basis, this is negative for commodities. So it's something to watch, especially, we talk about lumber prices and the outside influence with the CFTC commitment of trader numbers and watching the commodity funds. Look, the funds are watching interest rates bubble higher. They're watching the dollar spike up. There's no buy scenario for lumber with commodity funds right now. At the very least, they might be neutral. The reality is they're probably seeing lumber as a sell opportunity, just following interest rates alone. So again, something from that outside influence to watch. Commodity funds probably are not very friendly to lumber futures right now. They're not trying to pick bottoms from a valuation standpoint because the headwinds out there are pretty negative for housing as a whole.
And negative housing short term. Short term
Yeah,
means
absolutely. Yeah.
6 months to 12 months. And that was part of what the Chinese government also said. They were not coming in as the savior to help out the developers. And their focus was not going to be on residential construction. It was going to be on infrastructure, which I personally think is a pretty good move. As that country mature, well, as any country matures, but as they mature, they're going to need more infrastructure. So their focus is going to be roads, bridges.
No, I think it's all about infrastructure, and then infrastructure capex, and then also manufacturing capex. As China does come back online, there are going to be hiccups, but the reality is China is a good year and a half, 18 months behind where the Western world is coming out of COVID. They had that zero COVID policy. So now, you can kind of look at other countries, their roadmap coming out of COVID, where China, as they begin to flip the switch back on, it's just going to take, again, timing. And that's kind of my overall theme, especially with lumber. It has less to do with price. It has everything to do with timing. And Q1 is, for all intensive purposes, in the books. I think Q2 is likely going to be a slog, and you're just going to have to grapple around. And it's about the timing of, you've got to get to April 1st, April 15th. If weather cooperates, I do think churns relative to lumber begin to improve. But right now, the market's overwhelmed. And you see it as we'll kind of jump into lumber here with the spread structure, but the market is overwhelmed with prompt wood right now. So you need the churns to improve. You need the takeaway to improve. We know that we need more curtailment. So it's just going to be less about price and more about the timing. And you just begin to get out from underneath this pile of wood, and that just takes time to do it. But from a return standpoint, you still have, these are year to date, so the Dow is still up just under. Again, if you're an equity trader, you can make 4.5% to 5% on an annualized basis. If you're invested in the NASDAQ, you're up 1.2%. If you're invested in the Dow, you're up 1.4%. S&P, you're up just under 1%. So again, you're either going to sit in cash, you're either going to be invested in equities. You have a third alternative now. You can go into treasuries and yield something greater than sitting in cash. You can at least try to maintain, keep up with inflation, and you don't have to have the risk exposure of being in equities right now. Losers, unfortunately,
Well, hey, we're not the worst.
loser, lumber.
Middle of the pack. That's something new.
Yeah. We're not, it's we're not the bottom, so that's good. And so the other one that jumps out here is VIX, where this is another big indicator that there's probably volatility in equities, but in the grand scheme of things, that volatility is more sideways, and you can have spikes to the upside, spikes to the downside, but at the end of the day, you're going nowhere fast in equities. And so we talked about the Fed, interest rates, and so we can jump into lumber. And again, this is a monthly continuation. We had this spike up the last couple of weeks. We had the spike up last Tuesday, and unfortunately, there's no fundamental justification. So we keep slip sliding away where, do we see March going into expiration fill the January expiration gap of 344. It looks like an extreme probability to me right now. It's difficult to see what's going to stop that. And that, amazingly enough, I have customers on the books that are just taking delivery. They just took delivery last week of their January EFP contracts. So
Why is that?
it's just the way it's shipping out of the West. Just kind of when that, when you actually actually executed the EFP.
Oh, and the cars are just landing.
Yeah, the cars are just landing now. So it's tough to tell people there's value in futures. Maybe there is. Again, I think it all rolls back to the timing of it. At some point, these prices do represent value. It's not today. It's not tomorrow. Is it a month from now? Is it 6 weeks from now? Is it 6 months from now? And beauty's all in the eye of the beholder. As far as there's probably value in these numbers, but it's just the timing is more critical than anything else right now.
Well, one thing off the topic slightly though, with regards to timing, this new contract is going to be so nice. If you're taking delivery of a truck as opposed to a car, you can get that material so much quicker and
absolutely.
And more precisely delivered to the location of your choice.
Yeah, absolutely. And just so everybody's aware, instead of flipping, I'll pull let me pull this in here.
Oh, there you are. Looked like you had frozen for a second.
Here, I'm trying to I don't know why my computer doesn't like me today. Hang on 1 second here. Okay, here we go. Can you see that? I don't know why it's let me get it uncloudy here.
No, we're not seeing it.
Okay, hang on 1 second here.
You might have to unshare and reshare that.
Yeah, I think I'm gonna have to.
I think you shared the window.
Let's see here. Okay, so stop share screen. Can you see that now?
Yep.
And I apologize. I don't know why this is gray.
Oh, you just want to show that?
Yeah. No, I just want to show. So when you look at the nice part of can you see that? Is that can you read those numbers?
You know what? I can help you out on this one as well.
Yeah, perfect. Thank you. So the thing that jumps out to me, just so everybody's aware, we've been petitioning the CME, and they finally were able to get the technology built outside to do this. But you finally have a daily bulletin that's representative of everything lumber. So you have the mini contract, you've got the legacy contract right underneath it, and then you've got all the mini options that are trading all on one report now. So you no longer have to go to 3 different links. It's all right there. And so again, the top is the mini contract. And so, the thing that jumps out to me is that there were 52 March mini March EFPs yesterday.
That's great.
Which is, yeah, that's great. And there's going to be another big chunk of the mini. There's 121 Marches left. Another big chunk of those will be EFP'd, but there is mill participation now in the mini contract. So you are seeing mini EFPs along with the legacy EFPs, which is a very good thing. So yeah, I just wanted to point that out.
Yep, excellent. I like it.
And then let me go back to the slide deck here.
And that report is available at cmegroup.com.
Yeah, CME, just go to the daily bulletin and you'll just look for lumber. You'll see lumber options. And if you again, it's one link now that's got everything on it, which is a good thing. So here's the weekly continuation. Again, It just seems like we're coming back to fill the Jan expiration. There's minor interest to take March, but the reality is, Legacy March right now is a 367. The mini March last trade, it's 465 at 470. You can buy cash cheaper than those numbers today. And Eastern, Western, Euro. I don't think it's specific to one thing. And the one thing that I'm seeing, or a lack thereof, is any interest to accumulate volume at these numbers. I think the mills are quietly trying to peddle 350 type numbers from a volume standpoint to some of the bigger nationals out there, and there's not a lot of interest at the moment, where I think everybody's fighting the last battle from a cash standpoint. And when you look at the negative influence of Euro, when you look at print, it's interesting to see Southern Yellow Pine 4-inch at a premium to SPF. I mean, that's a pretty good indicator that Euro is infecting a lot of different markets right now, where you just can't compete against Euro.
Let me, I'm going to jump back. I want to show something for everyone. If we look here, the open interest in the Legacy March contract is 282 contracts. On the day, we've traded 102 Marches, of which 68 of them were spread trades between the March and the May. I would say this 282 is going to drop by, along with, there's probably some EFPs that go through.
Yeah, no, there's definitely, we're going to match off another block of mini and or at least Legacy March EFPs today. So that number is going to continue to drop. And just so everybody's aware, you have March expiration a week from today, next Tuesday.
Exactly. So it could very well be today is one of the last big liquidity days in March, and it's going to get real sketchy from here on out.
Yeah, and so we'll jump.
Oops.
Let me go back to so just here's the March daily, and you can kind of see. I mean, you're kind of the Bollinger Band lows in that 351 area. We know that Jan expiration was 344. Here's the mini March. Mini March traded sub 440. So mini March was a pretty good deal earlier or late last week, where you could have bought mini March sub 440. That's the they call it a 435. So that's the equivalent of a 340 Legacy. So you've traded some pretty cheap numbers there. And then here's the May daily. There's nothing really obvious. I guess you can make the case for whatever reason May could spike up. You're kind of smack dab. This red line here is the Bollinger Band moving average. So Bollinger Band low is a retest of the 381 area. Bollinger Band high is a 451 area. I think this would be a gift for producers if you got any sizable appreciation in May Legacy or the May mini contract. From a carry standpoint, I'll show you in the spreads. Here's the mini May.
Let's back up just a second. There's an old adage in trading: in a sideways market, don't diddle in the middle.
Yeah,
and that's
have a reason. Yep.
Everything that I'm seeing right now, I'm trying to build a case for this, trying to build a case for that, and I end up right smack in the middle still. And if it's boring and it's tough to be disciplined, but if you are trading anywhere in a sideways market, if you're buying it above the middle, you're going to have some issues. If you're selling it below the middle, you're probably going to have some issues.
No, I think that's a great point, Mike. And I think, what people have to remember is that when you look at May, you've got March expiration next Tuesday. So you're at that point where May, cash is cash, futures is futures. And when you look at what May represents, if you're buying May futures, that's really June, the second week, third week of June from a delivery standpoint, depending on where you'd be taking delivery. You're talking about really June 1st wood and beyond. So you have the reality of today, which is reflected in March, which is reflected in reflected in spot cash versus what May represents. May is a completely different time frame. You ultimately will have the convergence, but what his recent history has shown us that when this market does ultimately stabilize, you're going to get appreciation in futures first. You're going to try to engage cash, probably kicking and screaming. Fundamentally, there better be a pretty good, when you get that big push to futures to the upside, there better be a pretty good fundamental justification to justify that big build in the premium of futures over cash. The reality is, if there is no fundamental justification like we witnessed here in the last, really since January went off the board, these rallies are unsustainable. These are your supply constraint, violent spikes to the upside, followed by violent spikes back to the downside. And that's rinse and repeat until you get some kinds of sign, until you get fundamental justification from a demand standpoint. It's going to be difficult for demand to ratchet and follow futures. Any appreciation in futures, you're not going to get that follow through in cash. And then futures, spikes higher, comes collapsing back down, and you just rinse and repeat. So going back to what you said, you're in the middle. Be very careful chasing any type of momentum to the upside in futures unless there's some kind of fundamental justification and underlying cash in the demand component of housing, because it's unsustainable. And especially in taking out, and we'll kind of get into the CFTC numbers, the big elephant in the room when January went off was obviously the commodity fund short exposure. That's been removed from the equation in any meaningful way. So you don't have that big segment of people you can stop out to the upside. So be very careful. Like Mike said, you're stuck in the middle. I'd be very careful chasing momentum here, especially with cash dragging well underneath. If you're a producer, you want to sell these rallies, especially as you kind of match off your March EFPs. Producers should be replacing those March EFPs with new May sells to kind of help build out that order file. And so here is the May mini. Here's March, May, and I'm going to show one thing with the spread structure. So that spread's got, what's that?
That's legacy March, May, right?
This is legacy. So March, May has gotten out to negative 52.90. And here's your mini March, May. So the legacy March, May is playing catch up. This mini contract got blown out of the water last Tuesday on that limit up move in May, where it completely unraveled the spread thereafter, where this spread is actually traded to the negative 75 area. So, that's the other big red flag. Why is anybody going to buy March, 35, 40, legacy March 30, 35, 40 under when you could have bought the mini March at 70, 75 under? This is where it's critical to understand the spread relationships, not only between each contract month, but also the conversion between March and March, May and May, the mini versus the legacy. The reality is at negative 60 under, you should be buying mini March, not the legacy March.
Here's something I want to point out. 2 weeks ago, we were talking about basis trading. Like there was this unbelievable opportunity to put basis on over 50, maybe even 100. Everyone, we were beating pounding our fist on the table. Be ready for this. Take advantage of it. And it came in a week. This is another one of those opportunities. This is a $75 basis trade handed to you on a platter. You buy this EFP, do whatever, turn your March into cash, and you've got a hedge, a built-in hedge already on.
Yeah, and again, you have to wait for that convergence to play out, which is sometimes easier said than done. You can't basis trade if you have cars rolling and you can't put them on the ground, and the reload's telling you absolutely not. We have an embargo because we're loaded to the gill, like a PCI or down in Dallas, where they're having excessive cars reload issues. So, again, there's no blanket approach to basis trading, but at the very least, whether you trade futures or not, you've got to at least understand valuation and looking at the mini contract versus the legacy contract versus physical cash, and it at least tells you what's overvalued, where the value is. That's kind of part of the comprehension of looking at the truck-based futures versus the legacy futures and trying to relate it to spot cash. It's at least going to call out what's undervalued, what's overvalued, and at least point out some of those red flags.
Well, we need to remember that beginning of March, you could have put a $70 basis trade.
Yeah, and again, where I'm going with these spreads. So here's March legacy expiration. You can kind of see the last 3 trading days. So right now we're in that -50 area. If you're a believer that history repeats itself, and right now we're in an oversupplied market, if you believe that January, March legacy is any type of indicator, then you could see that legacy spread get blown out to -60, -60 plus. So something to watch going into expiration. You'll see how badly people, how badly the shorts want to deliver this. Are they going to deliver everything, EFP everything, and how badly, do people want to buy this? And it's in glaring indictment. If you don't get a lot of interest at -50 under March 50 under cash, that tells you you're in a completely oversupplied, the prompt wood out there, people are swimming in it, because history says that a -$30, -$35 spread represents value to potentially EFP that, and you're at -50. So if you're not going to attract new blood to take this to EFP it, then that's a pretty glaring indictment that you're completely oversupplied. And so, here's
to hop back to that spread, the one. I tell you what, if this develops, I would hope that there's some crafty traders out there that will take advantage of it.
Yeah, yeah, definitely. And again, this is where, look, if the legacy spread is out at -60, 65, and that mini spread comes into -50 or a -45, then take advantage of the widest spread and look at the legacy instead of the mini. If that mini gets blown out, then be willing to look at the mini. Whatever spread goes the widest, that's the one you should be looking at if you're going to buy March to take it from an EFP standpoint.
Correct.
And so the other, and thanks to Alex for building this out today, but full carry and all carry is the spread structure to carry the next contract versus the spot month contract. So that's all carry is.
I can interpret there a little bit. It's the cost. It's what what you got to pay.
Yeah.
It's the money out of your pocket to have
spot
this
on.
contract on.
And so, full carry should be around $20. You're currently around $50. So you're 250% just about above carry where you should be. So if you're short this market, you're being paid to roll your shorts at this point. So if you're not short this market in March and you're not going to deliver the wood, then, and this is what you're seeing today with the 60 some spreads trading, you're being incentivized to take your March shorts and roll them into March because you're getting paid. You're getting $30 more above full carry to move your March shorts into May.
Yeah, can you imagine if you put that basis trade on 2-3 weeks ago?
Yeah,
and
yeah.
You come in today and they're like, "Oh wait, you're going to let me roll this for another $50?"
Well, I mean, literally a week and a half, 2 weeks ago, this March-May spread had narrowed into that negative, call it a negative. I think it came into, there was significant volume done in that -13 to -10 area. And like at that point you had funds rolling ahead of end of February, end of month, and once that fund rolling stopped, that spread reversed on a dime and it went from a -13 back out to -25 to -30, and here we are today.
Yep.
And so seasonally, I'm not going to spend too much on this, but again, this shows seasonality with the last 2 years in it. A tale of two cities. A year ago, we were at 1348, to put that in perspective. So again.
But if you just drew arrows on this right now, on every year, if you drew an arrow which direction the market was headed, right now, everyone's going down.
Yeah. And again, this is, when you look at seasonality, you look at historicals. Do you look at a 3-year average? Do you look at a 5-year average? Do you look at a 7-year average, 10 plus? Again, beauty's all in the eye of the beholder, the art versus the science. So when you take out the last 2 years, yeah, seasonally, with the exception of 2016, 2017, history says we slide away here. And that, the old adage, he talked about this. I talked about this 2 weeks ago. Don't fall in love with your longs into Valentine's Day. Seasonally, when you take out the last 3 to 5 years, go back prior to 2018. History shows that you top out in February and then you seasonally slide into basically Memorial Day, U.S. Memorial Day, into the 3rd week of June. When you factor in the last really 3-5 years, okay, so history says that maybe there's another run going into May. And so again, what side of the fence do you fall on? There's no right or wrong way of looking at this, but this is where, again, it's imperative to understand seasonality. And do you reference how statistically significant are the last 2 years? Are they complete aberrations? Do you go back and ignore and just look at history? But seasonality wise, typically, if you're a believer that the last 2 years were an aberration, then you've seen the highs potentially for the year, as scary as that sounds.
I could make the argument, Greg, that the rally's already happened.
Yeah, no. And again, as much as I
premium.
don't want to believe that, well, I mean, seasonality wise and historically, you could make that case. Lumber's never that easy. We do know that the cumulative effect and again, this is where I think it has less to do about price and more about timing. The cumulative effect of all these supply curtailments is yet to be felt. There will be more shutdowns. And when we look at supply versus demand and the pendulum of lumber, where you swing back and forth, lumber's pendulum swings very violently. So rarely do you reach that point of equilibrium and sit there. You have a tendency to overcorrect. And so right now the market is overcorrecting from a demand standpoint. And you can make the case that demand has not bottomed. I certainly wouldn't make the case that demand is bottoming. You can't do that with interest rates still trending higher right now. So we know the cure is going to be felt on the supply side. There's more curtailments ahead. And as you get the cumulative effect of those curtailments, at some point, you probably overcorrect from a supply standpoint, and that there are probably better days ahead. And I'm not willing to say that lumber's made the highs for the year. We'll see what the back half of this year looks like. But right now, it's going to be very difficult. That full carry structure, that chart that we just referenced, there's a lot of prompt wood that needs to be cleaned up. There's a lot of work to be done to eliminate the misery of the physical cash that exists today to get to that point where the cumulative effect of these curtailments has a positive influence on pricing. It's not, it's down the road. It's just not today. And so you can see kind of March is back in its sweet spot of historical March expirations. There's nothing special about 365. You're kind of back where you belong. Here's May. There's definitely nothing special about May at 413. If you're a believer yeah, it's too high. Right?
There is something special. It's good price.
Yeah, well, it's a good price, and and if you're a producer, you could make the case that this is a really good price, right?
Yeah, you look back. I only see 2 times, other than the last 2 years, that start with a 4 or higher.
Yeah. So producers, the hope strategy has gotten you to this point. The reality strategy probably you need to look at more stuff like this. So here's your curve again. The curve suggests that not today, but at some point off in the future, there are better days ahead. And then so from a basis standpoint, March is basically there. You've had 100% convergence or 98% convergence. May still tells you that cash is a discount to May. So from a May valuation standpoint, you have to try to extrapolate out where is value in May. And when you go back to this chart, again, what does 413 mean? If you're on the buy side, you're still buying the upper, from a price band standpoint, you're still buying the high end of historical May prices. If you're a seller, if you're a producer, well, you're capturing pretty good numbers historically speaking.
Yep.
And
Not
so,
taking into consideration the inflation in the cost of production, of course.
yeah, absolutely. We talked about open interest. I'm cautiously optimistic that given the bear market structure that we're seeing play out here, I think open interest is holding its own, which is encouraging. And then when I look at the other thing, here's CFTC numbers, Mike, and this is great.
Big
So we're still playing catch up. We know that the managed money shorts got annihilated here. You still have these longs. This is as of the 7th of February, so you're still a month behind.
I think you need to use a little better term there, Greg. The managed money shorts took their massive profit, which they were short the whole way down.
That's a very valid point. Yep.
They walked off the dance floor and are sipping a cocktail right now.
Yeah, they left they cashed their chips out and said thanks. Realistically, they're back in, probably not to the extent that they were. And so then the other awesome thing here is we petitioned the CFTC. They finally did this. You finally have mini CFTC commitment of trader numbers. So they broke out the mini. And the one thing that stands out, again, this is a month behind, but this is before the Rogers Fund had rolled their longs into the mini contract. So you can see that you basically had just kind of the industry participation, other reportables, probably industry speculation. You haven't had the impact of managed money moving from the legacy into the mini contract. As you progress through February, it's going to be interesting to see how managed money. We know that the Rogers Fund, it's a fact, the Rogers Fund, because they said it, that it was a twofold move, that they moved a chunk of their positions from, it was a two-pronged approach. They moved part of their May legacy into the mini May, and then they did it again last week. So that also definitely had an influence on the that mini March May spread getting blown out last week, because I think it was induced partially by the Rogers Fund rolling and the other side not there to absorb them rolling. They basically were buying those mini Mays and helping to push that spread out.
All right, so let's talk a little bit about the opportunities where they lie right now. Absolutely, this March contract is a big discount. So if you have the capacity to somehow take a March or take cash right now, you can sell forward or sell the forwards contracts, the May, July. But something that's a little more esoteric, I think, and I looked at the Zillow around my neighborhood just to see how homes for sale. Literally, there's nothing for sale in the city of Chicago. It's crazy. Existing homes are not for sale. People are not leaving their existing home and going to get a new mortgage. It showed up in mortgage applications. Not shocking. Lowest number ever on record. Why would you go out and get a mortgage right now? Because you're not going to get a rate that's better than that you currently have. What this, all boils down to is that new homes are really the only thing to buy right now.
Yeah.
So there's an inherent demand in there. We're talking pretty bearish because once again, we have a myopic view of a very short time horizon, maybe the next, say, 4 to 6 months or less. But long term, there is an underlying demand because existing homes are not going to be for sale.
Yeah, I think it's going to be, I use the word slog, and I think it has everything to do about the timing and a lot less about price. But that being said, to me, the biggest thing to watch is interest rates. And the second you get a reversal in the yield curve, and the yield curve is trending in the wrong direction right now, but at some point, the market will price in that Fed funds terminal rate, and that will get baked into the cake with interest rates. And when that happens, you will get a reversal. You'll come back down to 6.5, 6.25. I do think you'll trade sub 6% again at some point this year. It's just not now. So it's that timing aspect where the first half of this year, Q1 into Q2, is just going to be gutting it out, and accepting the reality that it's kind of, where are you on that time horizon, and it's just going to take time to get to better days. But there's a shortage of homes. The existing homes aren't going to come on the market, so there will be business for home builders, single family, multifamily. It's just going to be sloppy right now. You just have to have a long-term perspective to get to that point.
I think the bottom line is do your homework, be prepared, take advantage of the opportunities when they come.
Absolutely.
All right, everyone. Thank you once again for showing up. We'll see you next week. Greg and most likely myself will be in Montreal in April.
Yep.
Where hopefully we can see some smiling faces in person. And then, of course, the third shameless plug for the StoneX Future School.
Yeah. And just, if you're going to be in Montreal, we're speaking with the CME, and it's it's not going to be anything earth-shattering as much as I think it's just going to be a good real-time analysis. You're going to be at the third. What is that? The 17th, 18th of April.
I think
so
it's
you're
18th.
going to be a little over 5. Yeah, I think it's like 5 weeks from now. So you're going to have a pretty good real-time snapshot of what's left in the legacy contract as you get closer to, just everybody's aware, May 15th, legacy goes away. It's done. So the truck is going to be the only game in town. At that point, you're going to have some real good real-time analysis statistics on that truck-based contract. So we'll be in Montreal to kind of share that with the CME, and I appreciate the time, and it's good to see you, Mike. It's good to see everybody, and we'll see everybody next week.
Greg, thanks so much for doing the work on getting the data onto the lumber, the bulletin, and the CFTC report.
Yeah, no, I mean, it just makes life easier. People need to see this, and again, I think it's going to be interesting, especially with that CFTC report, to see the transfer of the commodity funds into that truck contract. Because the last one, there's no fund participation. When you finally get to real time, it's going to be interesting to see where this is at.
All right, everyone, take care. Thank you very much for spending some time with us. We'll see you next week.
Good seeing everybody. Thanks, Mike.